Well, generally, you have to be at least 62 and older in most states. There are some options as low as 55 for some unique situations in certain states, but 62 and older, and they have to be a homeowner. So they have to live in the home and they have to be the owner. If they fit that criteria, this could be an option for them. So what is a reverse mortgage? I look forward to sharing that with you today. What it is, how it works, why, and why not. I'm Matt Helton, reverse mortgage expert. Look forward to sharing with you all the details. But have you ever wondered why in the world would anyone want to do a reverse mortgage? I don't even know what it is. That's what this video is for you today. Look forward to giving you all the details. So we all know what a forward mortgage is, right? Now, we may not call it a forward mortgage, but that's what they are. A forward mortgage, what that means is regular mortgage. You make payments every month, hopefully every month. And as you make the payments, the balance goes down, right? We're all familiar with that. Well, there's the other option. It's called the reverse mortgage. So what is it? Well, reverse mortgage, it's a type of loan that focuses specifically on homeowners that are 62 and older. So you have to be 62 or older for the majority of the reverse mortgages, and it allows them to borrow money against their home. So they have the ability to just get a mortgage, either pay off their current mortgage, or they can use it to buy a home on their home, have a mortgage, just like any other loan, right? Unlike a regular mortgage, though, there's some options. The senior doesn't have to make payments. So they don't have to make payments every month. They also have the ability to actually get money out as well. So they can either not make payments or the house can actually pay them. I had someone the other day said, well, it's about time. I've been paying for that house for years. Now it's time for the house to pay me. So it kind of reverses the script, if that makes sense. Now, the reverse part means the only negative, right, of this is if you're pulling money out, or if you're not making payments, that interest is added on to the loan. So that's where the word reverse comes in. The balance, instead of going down, the balance can go up on these as well. So you may be wondering, so how in the world does the loan ever get paid? Or I hear it a lot, how does the lender actually make money? Well, the loan gets paid in two forms. One is they do allow payments. So some seniors maybe have a cash flow where they have large lumps of sums of money come up all at once. So you don't have to make payments. Money comes in, then you can stroke a big check and pay the balance down. So it gives you some flexibility. Some seniors make payments every month. Some seniors even just pay the interest to keep the balance the same. Most seniors, though, because fixed income, cash flow situations, they don't make payments. Now, it sounds crazy, but they literally do not make a payment on the home. And then the only negative is the balance does increase just for the interest. And then how it's repaid is the senior still owns their home. They're still able to sell their home if they ever need to, and they can still pass the home on to the next generation. So that being said, how it's paid, either the senior decides they don't want to live there anymore or can't live there. They sell the home, pay off the balance, and still get all the equity that's left. Or if something happens to the senior, and if they have a significant other, them as well. So both people involved, if there's two, pass away, the home still goes on to the family. They have the ability to pay off the loan, refinance the loan, or most folks sell the home, pay off the balance, and then they still get what's left over in the end. So that's how the lender gets paid back, is normally the home is sold, pays off the balance. The lender doesn't take the equity, the family or the senior does. Does that make sense? Kind of the quick version. And then give you a little more background. Who's eligible? Well, generally you have to be at least 62 and older in most states. There are some options as low as 55 for some unique situations in certain states, but 62 and older, and they have to be a homeowner. So they have to live in the home and they have to be the owner. If they fit that criteria, this could be an option for them. So how does it work? Well, the borrower has a few options. Number one is they can receive money in a few different ways. Number one, they have the ability to actually get a lump sum. So they work through the loan process just like any other loan or any other mortgage. And at the end, they can actually get a lump sum all in their bank account all at once they can use for whatever. So that's one way they can get cash. The second way, they can actually receive monthly payments. So some seniors want to get, instead of a lump sum, they want to get money monthly, almost like an annuity. So basically their house is paying them to stay in their house, if that makes sense. So they can do a monthly. There's another option where there's a line of credit. So if you've ever heard of a HELOC before, home equity line of credit, or if you've even had a HELOC before, you know how that works. You can get a line of credit, pull money out of the house, use the money for renovations, repairs, medical bills, buy a car, or give the money away, whatever you want. The challenge with the HELOC is you have monthly payments, you have a variable interest rate, and you have a variable payment. Does that make sense? So on these lines of credits with the reverse mortgage version of the line of credit is you don't have a monthly payment, but there's also no due date or ending date. So it never expires. It only expires if something happens to you or you decide to sell the home. So you can get money out lump sum, get money out monthly, or there's the line of credit option. Now you want to hear something cool? If you can't decide, or if all three of those fit for you, you can do all three. So this is a customizable plan. You could get a lump sum. On top of that, you could get monthly payments, and you could use the line of credit as well. So sometimes seniors love it because they have lots of ways to customize their financial situation and use it what fits best for them. Hopefully that makes sense to you. So to hit on something again, how are these repaid? How does the lender make money? How does it work? That question I hear quite a bit. So to recap, how is the loan repaid? Well, number one, some seniors make payments just like any other loan. Some seniors just pay the interest, like an interest-only loan. A lot of seniors don't make payments at all. Then what happens? So the interest is added to the balance, and then the senior sells the home, which will pay off the balance, and they still get the equity. Or if something happens to them, they pass the home on to their family, they sell the home, pay off the balance, and they get the equity as well. So if you think through it, it sounds too good to be true, but it's not, because there's a few things that you have to consider. Number one is, if this is a good fit for you, is we can only loan low percentages. So the consumer protection side of this is the government, which insures these loans, always want there to be equity if all possible, because they're insuring the loan. So what they do is they would start off maybe at 25, 30, 40% of the value of your home. So for example, if you had a $500,000 home, maybe you could only borrow 125, 150, 200,000, depending on the older you are, the more you can borrow. And we can go more in depth about that. That means that the interest is a small amount added to your balance. So maybe you live in the home another 10 years. Well, if you borrow 125 at the end of 10 years, maybe you owe 200,000. You follow me? It's a $500,000 home. So that means there's still lots of equity there for you or your family. I hope that all makes sense. That's a lot of consumer protection. The other part of consumer protection that's been added is it's called counseling. So you have an 1.5-hour counseling session with a counselor that goes through more details after we've already shared the details with you, but there's more details, how it works, how it's paid off, how it works with the family. You go over all this with the counseling. And then another level of consumer protection is, let's just say, if you're worried about an economic collapse, you're worried about a real estate collapse, I totally get it. Who knows what's going to happen in the future, right? So some people would say that's risky. You borrow money, the balance goes up. If your house collapses, what's going to happen? Are you going to be stuck with a big bill? Are your family going to be stuck with a big bill? That's the last thing you want to worry about if something is going on with you and going on with your health. So that's where FHA has mastered this program to ensure your peace of mind, but also to ensure the family. So let's say that scenario earlier, your balance goes up to 200. because you don't make a payment, you've used all this equity, you've had a good retirement, etc., the value of the home goes down and say it's only worth 100. I know it's not going to happen. Probably not. But let's say it does happen. You owe 200, it's only worth 100. Are you leaving your family with $100,000 bill that they have to write, check they have to write to pay it off? No. That's where FHA steps in. That insurance would actually pay that. So the insurance would wipe that away. You wouldn't have to worry about it, and your family wouldn't have to worry about it. So as you can see, there's lots of consumer protection that's really, really taking care of a lot of the concerns with this program. So just to give you a little more background so you can check this out, the most common version of this program is called a HECM. HECM. Did you catch what it sounds like? Almost like HELOC, but a little different. So HECM, reverse mortgage, stands for Home Equity Conversion Mortgage. Home Equity Conversion Mortgage. This is the FHA consumer protected version of the reverse mortgage. So that's the one that allows you to get a little money up front, allows you to get monthly payments, but also allows you to have that line of credit as well. And it is insured by the Federal Housing Administration. Thus, FHA is involved. So if you've ever heard of FHA, first-time home buyer, low down payment loans, you've heard of FHA down payment assistance. This is another version of an FHA mortgage. It's just the senior version that helps you stay in your home, helps you have a better retirement, helps you with cash flow, helps you work on your home, helps you take advantage with that fantastic investment that you made called a house. Take advantage of all the responsibility that you had where you made all your payments and paid it off, or you made a lot of payments and you've gained a lot of equity. There's some options there to help you. So I know that you probably have more questions. I know that you probably have more concerns. I know you probably have more things you want to learn about this to see if it could be a good fit for you or your family. That's what we do. We focus on education. That's why we created this channel. That's why we created the podcast. That's why we do what we do on a daily basis to help seniors thrive in retirement. So please feel free to reach out to us if you'd like to learn more, the pros, the cons, how it works, and how it could work in your specific scenario. We do free consultations. We do not require a credit check at the beginning. We just get some background on the value of the home, how much you owe, and your age. We can do some preliminary numbers for you just to show you how it works. Our goal is to help seniors thrive in retirement. So if you'd like to thrive, please give us a call or subscribe to our channel or share this with someone that needs to. We'd love to help. Matt Helton, thanks again. Have a great day. Talk to you soon.
Hey, this is Matt Helton with OneTrust Home Loans, home of Retirement Mortgage Solutions. And we really do appreciate you checking out the Serving Seniors podcast today. Now, please go to the description down in the body of the podcast where you can subscribe to get future shows. Please click that notification button so you get notified when other shows drop. And also, if you can go to servingseniourspodcast.com, and we'd love to hear a comment about our show. We have a heart to serve seniors, and we have a heart to make sure seniors don't just survive retirement, don't just get by in retirement. We want to show seniors how to thrive in retirement. So if you know of anyone that's 55 and older that could use some extra cash flow, maybe the retirement's not going the way that they like, our retirement mortgage solutions are designed for folks, depending on the state, they're either 55 or 62 and older, to make sure that they have that kind of retirement that they want. As long as they own a home and they're in a good equity position, there could be some solutions that they may not have thought about, or maybe they've thought of and they just didn't know how they work. That's what we do. So anyone in that age group that could use some mortgage advice, my team and I would love to be able to help them. Thanks again, and look forward to seeing you on the next show. Have a great day.